In this week's Fastest 4 Minutes in Finance, one of the most important election issues that neither candidate is talking about. Hello, and thanks for joining us this week. I'm Scott Inman. Well, we've recorded several segments over the past few months that have focused on the presidential election, and there has been a common theme. The stock market doesn't broadly care who is elected. It has performed well in both Republican and Democratic presidencies. What matters more than who is in office is how healthy the economy is. When corporations are profitable, stocks generally rise in value, and investors grow their wealth. Right now, that is the U.S. economic backdrop. Inflation is down. Interest rates have been cut and will likely continue to be cut. The unemployment rate is low, and corporate earnings, as well as future earnings, are strong. So what could threaten that? Well, there are many important election issues that voters will assess and use to make their choice for president in a few weeks, and we are not trying to take away from their importance. But from an investor perspective, neither candidate, nor any congressional candidate for that matter, is really talking about perhaps the biggest threat to all of our financial independence, and that is the U.S. debt. The debt is $35 trillion. But First Trust Chief Economist Brian Wesbury tells us that big scary number is not what we should be focused on. He writes in a recent article that we should focus instead on the net interest cost of that debt relative to gross domestic product, or GDP. He says we should think of net interest debt like a national mortgage payment relative to the national income. Makes sense. In our personal finances, we want to make sure we have margin between what we make and what we have to pay on our mortgage. So Wesbury writes that in 2023, the interest burden hit 2.4% of GDP, the highest since 1999. He also writes that in 2024, it's projected to be 3%, the highest since 1996. It's risen over a very short amount of time, too. He says in the 12 months ending March 2021, net interest totaled $315 billion. And in the most recent 12 months, it totaled $872 billion, a 177% increase. That's largely due to increased government spending during the pandemic, followed by a spike in interest rates, making the debt service more expensive. Now, Wesbury believes that the surging net interest will be addressed and ultimately curbed, and that's because we've been here before. The government's net interest obligations totaled 3% of GDP in the 1980s and again in the 1990s. Both parties at that time enacted policies that helped bring the percentages down, like increasing payroll taxes and cutting spending. But this time around, nobody is talking about a plan to do that. Wesbury believes by 2026 the issue will have to be addressed. If it's not, it threatens our economy, our investments, and our financial independence. Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.